a couple more people, but still, it's a couple more people who think maybe rates will raise a little bit sooner. The forecast for GDP, they see 6.5% now. Just 3 months ago, they only thought 4.2%. Are we starting to see the possibility of rate hikes that maybe do come a little bit sooner than Fed Chair Jay Powell seems to think they probably will right now?
It's certainly possible. I mean, we don't have a lot of experience with recoveries from pandemics, and we don't have a lot of experience with recoveries with this kind of monetary and fiscal policy stimulus behind it. So it's certainly possible that it could happen faster than what the Fed's projected. It's interesting that still the baseline view of the Fed is no rate hikes through 2023, even though there are a few people on the FOMC that think it could come a bit sooner.
Well, if you were at the Fed, if you had been at that last meeting, you didn't leave that long ago, what would you be pushing for? What would you be projecting?
I would probably be more in the camp of happening a little bit quicker. This is pretty unprecedented in terms of, how the economy is going to bounce back, hopefully, as we open up the economy later this year. And with monetary policy and fiscal policy providing a lot of support, I think the economy is going to be very, very strong. I think, the key issue here, though, is the Fed is following a new framework in terms of how it conducts monetary policy. It's basically said that they're not going to raise rates until they've reached maximum sustainable employment, inflation's at 2%, and they think inflation is going to rise above 2% for some time. So the Fed has basically said, we're going to be very slow to start the process. So that means that's why the beginning of tightening isn't for quite a while. Now, what it also means, though, is when they do finally start, they're going to have to do a lot. They're going to have to catch up, because when they actually start to tighten monetary policy, short-term rates are going to be very low relative to where they actually have to go.
Well, of course, the bond market, in spite of all the things that Jay Powell said today and the things he said recently that already reinforce this, are still, if they're looking for anything, they're looking for more inflation staying higher longer, especially with unemployment expected to fall, huge stimulus in the wings. So I want to have you listen to something from Scott Minerd. He's the CIO of Guggenheim Partners, what he told us earlier today on Bloomberg Television.
This dot plot today, there were some pretty significant changes in it, not dramatic, but there's more and more of a consensus building. This rate increase is coming faster than the chair is advertising.
So does the bond market maybe have it more right, and would you agree with it?
Well, I think the bond market is reacting to the fact that the economic outlook is improving, and they're reacting to the fact that there's a $1.9 trillion fiscal stimulus package that's being enacted. I mean, the rise in bond yields is still pretty modest. I mean, we've taken the 10-year Treasury yield up to about 1.6%, but that's not a high rate, especially given where the Fed thinks it's going to end up. If you look at the Fed's projections, they think a neutral short-term interest rate is 2 to 3%. So it seems to me that 10-year Treasury note yields are ultimately going to go to 2% or higher. And the backup we've seen to date is actually pretty modest.
Are you as convinced as Fed Chair Powell that inflation expectations are now anchored around 2% and it will be all but impossible to budge them?
Well, it's certainly been hard to budge them for a very long time. That said, the Fed is taking a different strategy to how they're executing monetary policy. They're telling people in the markets that they're going to be late rather than arrive sort of on time. And so inflation expectations could react to that in a way that the Fed doesn't anticipate.
Well, we're already seeing a weaker dollar, rising bond yields, the yield curve is steepening. How strong are those signals, and how much should the Fed be heeding them?
Well, a lot of these signals are actually good things. I mean, the fact that the economic outlook is improving is having an influence on bond yields and the shape of the yield curve. I take a positive signal from that. People are more optimistic about the notion of a sustained economic recovery. So I wouldn't be concerned by the backup in bond yields that we've seen. I think the bigger concern is really what happens down the road if the Federal Reserve is really too slow to tighten monetary policy. If the Fed's too slow to tighten monetary policy, then at some point they're going to have to catch up. And that catching up process could be not very pleasant for financial market participants. But that's still way down the road.
Bill, is there another angle here? The Fed has been criticized for raising rates too quickly, starting in 2015 prematurely. Democrats control Congress. They will surely push back, and maybe Republicans too, when the Fed does feel it's time to start giving that signal. Is this new strategy of saying, oh no, we're going to let inflation rise above that 2% target, stay there for a long time, part of a strategy to allow themselves to be forced into a situation where inflation is such an issue that they have to do something and won't get that criticism?
Well, I think that what they don't want to do is inadvertently keep people unemployed because they're worried about prospective inflation that doesn't actually arrive. So last cycle, we got down to a 3.5% unemployment rate and there was no negative inflation consequence. This time, the Fed is basically saying, we're not going to worry about inflation until we actually see evidence of it. We're not going to worry that we're beyond full employment until we actually see evidence of it. We're not going to do it on forecasts. I mean, Chairman Powell today made it very explicit. He said, we're not basing our change in monetary policy on our forecast. We're basing on what we actually see in terms of real economic activity and actual inflation outcomes. That's a change.